Hello and welcome to Wealthion's Weekly Market Recap. I'm your host, Andrew Brill. David Lynn stopped by to speak with Anthony Scaramucci on Speak Up and talked about Truflation and the state of the economy, and also wisdom from Warren Buffett and Charlie Munger.
So, I mean, all of this stuff I basically agree with. And one of the things I track, and I'm sure you track it or aware of it, is something called Truflation, Truflation. If you go to truflation.com, it's a decentralized way to get inflation data from the overall market. And so what they do is they send out tremendous amounts of tags to people to report prices around the country, at the gas pump, in the food supply chain, if you will, the grocery stores, etc. Truflation.com has two statistics. I want you to react to both of them.
Sure.
Statistic number one is the US dollar has lost 25.44% of its value since January of 2020. So the inflation that was inducted into the economy as a result of lax monetary policy and tremendous fiscal stimulus has cut U.S. purchasing power by 25%. It's also had effectively eliminated 25% of the U.S. debt, because that's what inflation does in terms of real terms. You still have the nominal debt out there, but you have that kind of inflation, you're wiping away a swath of it. I want you to react to that. And the second piece of data is I logged in this morning in preparation for our interview. U.S. inflation, government reported inflation is 3.4%, but Truflation is saying it's only 2.6, which is consistent with what you're saying, is it's more real time, and they're probably picking up some of those big box grocery store price reductions that you're inferring. Their trend line is down. They expect this Truflation number to go to 1.5% over the next 12 months. So, number one, I want you to comment on the loss of the dollar, the value of the dollar. What does it mean?
Yeah.
And then number two, if you were the Fed chair empowered with this data, what would you do?
Okay. Let's answer number one first. Loss of purchasing power only affects the bottom 50%. What it basically means is that we have a widening wealth gap. What do I mean by that, Anthony? Well, what happens when we have inflation that's wiping out the purchasing power of your dollar? It means we also have asset price inflation. The stock markets, Bitcoin, as you know, cryptos went up a lot more than 25%. So the wealthy 50% of the population, well, it's really just the wealthy 10% who own assets, they're getting wealthier. Their net worth has increased by more than 25%. They can afford the loss of 25% down on their purchasing power. That doesn't mean much to them. Actually, this is backed up by real data. If you take a look at the Federal Reserve data, the wealth gap has widened. Let me just pull this up, so I don't want to quote wrong numbers here. But the wealthiest 1% has seen look at this distribution of household wealth. If people want to Google this themselves, distribution of financial assets. So the top 0.1% now own $19.9 trillion worth of wealth. Now the top 1% own $24.6 trillion of wealth. The bottom 50% own $3.6 trillion of wealth. The top 0.1% now own more wealth than the bottom 50% combined. That wealth gap was not this wide 10 years ago. So with the loss of purchasing power from inflation comes the rise of assets that will make the wealth gap wider. That's the first thing that we have to be aware of, is that the loss of purchasing power doesn't affect all equally. And in fact, what comes as a result of that is actually more beneficial, I believe, to those in the top 1% who actually own financial assets. To your second point, what would I do if I were the Fed? Well, first of all, the Fed has a mandate to look at official data, not true inflation, not real-time data, not data by other agencies and organizations and economic economists. They have to look at their own data, and their own data is unfortunately lagging. So to answer your question, I wouldn't do anything because I can't look at that data to react to it. What I suspect may happen over the next couple months is that the CPI data released by the BLS will slowly catch up to what you're probably reporting right now, which is Truflation. So would I react to this right now if I were Jerome Powell? No. Would I start reacting to it if the PCE, the core PCE, as reported by the BEA, starts coming down above below 2.5%? Possibly. But again, I still have a 2% mandate to reach, and that we're nowhere close yet by either headline CPI metrics or the core PCE metrics. So the answer to the question is, unfortunately, not much.
Okay. So, I mean, this is great commentary. You're a Buffett and you're a Munger watcher. So tell me what we can learn from them. And when you talk about bulletproof investing, what could we do to make us bulletproof today?
Buffett and Munger. Okay. Yeah, I interview a lot of value investors. I've never had the chance to interview Buffett, and sadly, I'll never have the chance to interview Munger. But I spoke to a psychologist yesterday, and I just want to share a piece of what he told me. This is Robert Cialdini. I don't know if you read his book, Anthony.
Yeah, Psychology of Persuasion.
Yeah, Influence. And Munger actually, when he read the book in the 90s, told a Harvard commencement class that in a speech that everybody, I'm paraphrasing, but everybody should get a copy of Influence. Everybody needs to pass it on to their friends, family, children. Apparently, Munger was so impressed by this book, and apparently, according to Cialdini, who told me on the interview, it made Berkshire Hathaway so much money by chapter 2 or chapter 1 that Munger actually sent him one Class A share that Cialdini still holds today. And I asked him, what does Buffett do that perhaps other fund managers should learn from? He says every annual report on the first page, first thing they do is list the mistakes they made the previous year. They said, these are the mistakes we made. Okay. We're going to learn from this mistake. We're never going to repeat this mistakes. And then importantly, he bridges that into the successes they've had in the previous year, the things they've done well. What does this do? This, according to Cialdini, allows people to gain trust. This is not a management team that is beyond his own ego. He doesn't have an ego. He's going to learn, and he's going to make everything better for shareholders. At least that's the image that this kind of messaging projects. They also use words like family, like, you're treating shareholders like a family member. It brings a sense of unity. It brings a sense of togetherness. Cialdini said he never sold that share because of that reason. Also because I'm pretty sure the share's done well, so that's probably another reason. But Buffett does a lot of things that he calls one of the pillars of persuasion is reciprocity. So what people do for him, he'll try to do for others. That's one of the pillars of persuasion that I think that has made Buffett very successful, at least according to Cialdini in his book. What else do okay. Stepping aside from the psychology aspect, what do we know about Buffett's investing style? One of the things that strikes out to me is that he doesn't buy things until he claims that he or his team fully understands it. For the longest time, as you know, he's missed out on Apple, right? And there was actually, I watched a CNBC interview a while ago where the reporter asked Buffett, why didn't you buy Apple? Do you regret not buying the stock? And he said, well, of course, looking back, I regret missing out on the gains, but, I don't regret being on a boat or captaining a boat I don't feel confident enough to be the captain of. In other words, he didn't know the stock well enough to actually own it. And now, as you know, it's one of the largest holdings. So has he missed out on gains? Yes. But this approach to investing has limited his losses as well. I think so many people rush into things not fully understanding it. You see that in the crypto space a lot. You're an expert on the crypto space. A lot of people rushing into things they may not understand. And granted, it's a difficult space to understand. But I think if you actually just take the time to learn more about which project or asset you're buying, you may actually have a lower chance of realizing losses. That's something we can learn from Buffett. It's not just value investing, it's his approach to risk management that we can all learn from. And the value investing is self-explanatory. He buys things that he believes are cheap. And there's various approaches as to how you can evaluate an asset's valuations relative to its peers. But I would say what stands out to me is his reluctance to jump into something that's new and hot.
I was It's probably 20 years ago. I think you'll enjoy this story. I got a call from, so I used to have a relationship with my first RIA with Fidelity, and they had me in their advisor referral program. And there was an Asian gentleman living in a sort of one of those one-story ranch houses in Weston, Weston, Massachusetts. And I flew up. I took the shuttle up there. I drove to the guy's house. I went into his living room. It was a very modest home. And he said that he saw me on TV. He wanted to ask me for some help. I said, okay, great. What would you like me to do for you? And he said, well, give me a second. He went upstairs and he took out a statement that he had from Charles Schwab. And he had, and this is 20 years ago, he had $500 million, and I'm going to repeat that. He had $500 million position in Berkshire Hathaway. He had bought the position in 1968. It was 42 years later.
Yeah.
And he had $500 million position. Now, if he had kept that position, it's $1.5 or almost $2 billion today. Man was in his 70s. He said, what should I do with this? And I looked at him and I said, nothing. You should do nothing with this. And that you should, the smartest thing you can do sometimes in life, David, I think you know this better than anybody, is nothing. The emotions and the whims that we carry with us in life in our primordial brains could knock us out of great investments. And so I wrote to Buffett in 1997. I used the Noom de Plom of my daughter, Amelia, who was 18 months old at the time. And I said, Mr. Buffett, I just bought a Class B share because we didn't have the money to buy a Class A share at that time, even though it wasn't really that much, 15 or so thousand. And I said, what advice do you have for me? I have a life expectancy of 84 years. I have 82 and a half years left, which I can hold your stock. Buffett wrote back. I have the letter framed in my office. He wrote back and said, I think your decision to own the stock for 82 and a half years is a manifestation of short-termism. My own intention is to hold this stock for 100 years. And I love telling people this because if you change your mindset about investing and you make it way longer term than other people think, you have a material advantage over them. And if you could take your ego and you could take your emotions out of things, you have a material advantage over them.
One of our registered investment advisors, Jonathan Wellum of RockLinc, talked with Wealthion this week and shared his views on the economy and how the consumer is feeling. He also touched on the unsustainable debt levels.
And I want to get your views on the economy. The U.S. economy has been amazingly robust, but there feels like there's an underlying element of uncertainty, a sense of uneasiness. And this was reflected recently in the consumer confidence number, which came in at the lowest level since July of 2022, so almost 2 years ago. And what's your sense of the U.S. economy here?
Well, I mean, again, I think you have to make do a separation between what we're seeing on Wall Street and some of the enthusiasm with stocks, and then what's really happening on Main Street. And so, from our perspective, those can't stay detached forever. And so, yes, you've got a lot of enthusiasm on Wall Street. They're looking at these numbers and they say, okay, things are trending the right direction. Interest rates, we might get some cuts this year. I mean, at the beginning of the year, as you know, it was like they were going to just slash rates. Now it's looks like, well, it would be lucky if we get 1 or 2 rate cuts and so forth. And yet there's this tremendous optimism that continues to percolate on Wall Street, in particular amongst some of the large tech stocks. But it's also filtering down into even some of the smaller stocks and securities. But on Main Street, as we see here in Canada, it's tougher times. And so people have much larger mortgage payments. Car payments have gone up. Insurance for cars, autos has skyrocketed. Food costs have gone way up. And so consumer spending is being pinched significantly. People are concerned about the future. And so that, I think, is starting to come through in the numbers. We see it especially in the retail numbers, and in discretionary spending is coming down. Restaurants, spending and so forth has also been impacted. So I think the picture actually on the street is much tougher and much more difficult for the average person, given the rapid rise in inflation over the certainly the Biden years, the last 4 years, and versus the income gains, and all we have is more and more threat of more taxes and from the government. So I see a bifurcation. My concern as an investor is we want to make sure we're buying businesses that are resilient, can take a tougher environment, because I think it's coming. And I think Wall Street is going to have to wake up to some of the more of the underlying and long-term realities that are facing the market.
And when you say you think the U.S. consumer is under pressure, what are you looking at specifically? Are there any indicators specifically that tells you that they're in trouble?
Yeah, the spending numbers. And so you've got where people are spending. So they're not spending in the areas that are highly discretionary. Those are starting to come down. So we're seeing that in food numbers. You're seeing it in terms of the even Target's number just released this morning. I mean, they're under a certain amount of pressure. You've seen it in restaurants and restaurant spending, Starbucks and so forth. And so you're getting pressure in those particular areas. And so that's where I think you're starting to see some of the pressure and some of the issues. You're also seeing in the large uptick in debt. So we look at credit debt, and that's gone up a great deal. People are borrowing more money. Their savings rates are down. The saving level is one of the lowest it's been in a long time. So they're consuming every dollar that they're earning. And that's, again, not a good thing if you're not building up savings in the economy. So I think you're seeing it both in terms of spending patterns where people can pull back. They are starting to pull back. And of course, you still have to continue to buy the basics, and you still have to fund a lot of your necessary expenses where it's inelastic demand. You just can't stop spending. But you're also seeing it in the uptick in debt, in credit card debt, mortgage debt, and so forth. So those are concerns for us.
So you touched on debt levels, and I want to talk about the federal debt now. It's currently at around $35 trillion. It's increasing by $1 trillion every 100 days. When I touch on these numbers, it just blows me away. It's like we're throwing around $1 trillion now like it means nothing. And so I want to get your thoughts on this. And then we can't forget the fact that it is an election year. So the Biden administration has been spending trillions of dollars to keep this economy going. I recently read an article that said for every $1 trillion that we are getting in terms of GDP, it's costing U.S. taxpayers $1.5 trillion. So not a good use of funds. But what are your thoughts on the U.S. debt levels? And is this an issue of concern?
It's a major concern. They're absurd. It's complete and utter insanity. So, when I was doing my commerce degree at McMaster back in the early 80s, that's when Ronald Reagan was president. That's when they first went over $1 trillion. I believe it was 1983. It's now 35 trillion. So you've had a compounding at over 8% a year, with a growth in the GDP of about 4% a year over that time frame. So you've got about a 4% per year gap over the last 50 years almost. So this is not sustainable. It's what you call insanity. You can't take a debt to GDP from 30% to well over 100% and then think you can continue to do that at a increasing rate. In other words, the second derivative, is actually, positive number. So you're growing now debt at a level, whereas you've already pointed out, I've seen different numbers for every increase in dollar in debt, you might be getting 30 cents of GDP. I mean, this is a complete flop. This will not be able to continue. So it's not sustainable. And the very fact that it continues to be sustained, it continues to go on, does not mean it won't come to an end. And so I think investors need to be very careful. When you're adding $1 trillion every 120 days, on a tax base of 6 to 7 trillion, federal government. I mean, you cannot make these numbers up. So, no, it's not sustainable, and that's one of the reasons why I think you've got commodities, things that are priced in U.S. dollars, gold in particular, silver, starting to go up, and people are being concerned and using these as safe harbors. There's no way we can continue to have a standard of living and have a stable economy with this kind of debt being added to the system, and particularly with the world's leading economy and also the reserve currency of the world. So I think investors need to wake up, and they need to be, again, I'm not saying run from the market, but you need to be allocating capital intelligently, wisely in different areas that at least might protect your purchasing power. I saw a great chart the other day. And it just had, from gold from the time that Nixon took, basically the U.S. off the last vestiges of the gold standard back in August of 1971. It's $35 an ounce. It's now around $24.50 or so. And that's actually grown faster than the S&P over the same period of time, if you take that 53-year span of time. And so what that tells you, though, is that we've seen a massive devaluation in currency. And so if we've already had that, watch out ahead. I mean, you cannot be continuing to add this debt. We've seen it also in Canada. We've seen it in many countries around the world. But the U.S. right now is out of control when it comes to their debt.
I got to ask you about the Canadian stock market now. And the S&P is currently up 12% on the year after being up 20% in 2023. I'm not even going to mention the NASDAQ because the numbers are significantly higher, but the TSX, or the Toronto Stock Exchange, is up about 7% year to date. I'm not too sure what it was up last year, but there's no way it was anywhere near what the S&P was up. And then you talked about, we both talked about the taxes and the excessive tax burden that we face as Canadian investors. We got a slowing economy. As a Canadian investor, how do you get ahead?
Well, I think the benefit of being an investor is that you can target the companies you want to invest in and try to buy into the companies that are least affected by the bad Canadian government policies currently, and hopefully those change. So what do I mean by that? Well, we can as investors, we don't have to invest in companies that are 100% exposed to Canada and all of the challenges within our own economy. So we can buy into the US, we can buy into Europe, we can buy Canadian-based businesses that are making money all around the world. And so I think that, for Canadians, what they need to really focus on is how can I best make sure my capital is going into the kind of businesses that can grow, can expand in productive ways, and are not hamstrung by bad Canadian policies and bad Canadian governments, which we're seeing, not only our federal government, but many of our provincial governments too. So that's the way we get around it. And so we just invest outside of Canada or in businesses that maybe are Canadian based, but make money all around the world. And I think that's probably the most productive way of doing it. And then at the same time, putting as much pressure on our leaders and our neighbors and so forth to say, hey, how can we change this? And let's be looking through the resumes of the people that we're putting into power, and making sure these policies really fit with the best long-term objectives of our country.
Jonathan, as we wrap up, you've painted a pretty negative picture about the Canadian economy. What's it going to take to turn this economy around and to right the ship?
Well, I'll give you a really brutal and honest assessment. A changing government at the federal level, and I think in many of our provincial governments too. Many of them are not running their provinces very well. But I think, look, we need to shrink the size of the state. The state is much too large. It's subsuming way too much of our economy. We've got to lower taxes, not increase taxes. We need to unleash our extractive industries, our commodity industries. We should be deregulating and making sure that we are maximizing our oil production, our gas production. We're exporting our natural gas into Europe and also into Japan, down to the Far East where there's the needs. We need to be deregulating in so many areas, and we need to put more of our economy into the private sector. So if we're not committed to doing those things, shrinking the size of government, shrinking regulations, getting taxes down, balancing our budgets, and putting competent people into places of leadership, it's going to be a tougher go going forward. But if we could reverse some of those policies, this country is amazingly wealthy. The people are incredibly resilient. We've got a lot of talent in this country, and we could really, I think, make a dramatic change in the country in a relatively short period of time. But we just need some of those tough decisions made, and I think Canadians are increasing, I think, at the point where they are looking for change. And so let's just pray that is the case. And we have got the leaders that step in that are prepared to make those tough decisions.
Chris Mancini of Gabelli Funds joined Wealthion to talk gold, why central banks are hoarding gold. He compared gold to silver and also how some gold is being diverted into Bitcoin.
So gold has caught a bid in the past year. It's up over 20% on the year. And one of the reasons why is because of central bank buying. In both 2022 and 2023, central banks acquired approximately 25% of global production. And why have central banks been such aggressive buyers of gold?
Yeah, central banks have been buying because primarily the Chinese central bank is the biggest buyer. And the reason that they're buying is because they saw what happened to Russia. When Russia invaded Ukraine, the United States and European countries essentially confiscated Russia's dollar and euro denominated reserves. So around $500 billion of total reserves were essentially taken from Russia. And the way that the US and the European countries were able to do that was through saying that we weren't going to pay Russia back. So Russia owned U.S. treasuries, and essentially, or not essentially, in actuality, had lent the U.S. government money. And so what we said to Russia was, okay, look, you invaded Ukraine. We don't like this. We are not going to pay you back on that money that you lent us. So China saw that happen and for lack of a better term, I think, started to freak out and went, wait a second, we have $1 trillion of treasuries. There's a distinct possibility here that if we do something in Taiwan or, if we do something that the U.S. doesn't like, they could say, we're not going to pay you back. And so China's diversifying out of dollars and into gold. And that's also trickling through the rest of the world central banks that hold dollar-based reserves. They're saying, look, it could happen, right? Like if we own treasuries, it's a liability of someone else, right? So we need to watch out for that. So other central banks are also diversifying out of dollars and into gold.
I want to get your views on silver now. It's finally above $30 an ounce, touch wood, and it's up over 30% on the year. What are your thoughts on silver, and do you think it keeps going?
I think silver's the poor man's gold, really, at the end of the day. So when we do see this, like gold have a run, silver tends to have beta to the gold price. So silver tends to like catch up to gold on the upside. And I think that happens so gold tends to move first, then silver tends to catch up. And I think the reason that happens is because silver does have a very big retail following, I think, within the US. So I think that, people really see that they could buy, 1 ounce of gold for $2,400, or they could get at this point, I forget the exact ratio now, but something like 85 1 ounce silver coins. And it feels nicer to hold 85 ounces than to hold 1 ounce for $2,400, which is a substantial amount of money. So I think what happens is there is this demand for silver from retail as the price of gold goes up. And I think that if the price of gold keeps going, I think silver will do better than gold.
And so we have gold trading at or near all-time highs, but silver is nowhere near it. I think $50 is the all-time high. And if you were to adjust that for inflation, it would be significantly higher. But do you think we take out $50 here in the next year or 2 years?
I mean, that's a big move, from 30 to 50 is a huge move. I mean, I don't know if we'll do that. I mean, I remember when it was at 50 and that was, there's a lot of speculative hype around that at the time. That was when, like you said, and there was also a lot of speculative hype around gold at the time. I think that, if gold goes to 3,000, above 3,000, then I think that we could see silver touching a 45 range. Definitely.
And so why do you think silver is underperforming? Why isn't it trading closer to its all-time high?
I think the issue is that what's driving the gold price is this demand from central banks, like the Chinese central banks and other central banks around the world. There's Eastern demand for gold. Whereas I think that in the US, you'll start to see demand for silver if the gold price from retail, if the gold price really goes. In the East, in China, Korea, there isn't that same affinity for silver that we have here. It's really gold. So they'll buy a very small little bean, of gold rather than buy 1 ounce of silver. So I think that what we have to do is like, and we've seen that there's really no interest for gold in the U.S., very little. So I think that in order for silver to really have its run, we're going to have to first see the gold and the ETFs start to go back up. So we're going to have to see again, like the price of gold have another move here from 2,400 up to say 2,600, something like this, before we see silver really make its move, and that'll be predicated on retail demand in the U.S.
One of the unique issues associated with silver is that 75% of all silver comes or is produced as a byproduct. Okay, so copper producers, for example, are very large producers of silver. Do you think this also comes into play? And I guess when I ask that, what I mean is if you have copper trading at or around $5 a pound, and you have somebody like Codelco, the world's largest copper producer, and they're just pumping out as much copper as they can, well, they're also producing a lot of silver, and they're just dumping it onto the open market. Do you think this comes into play?
Yeah, I mean, it would, but I think that kind of what's attractive about that analysis or that dynamic that you just mentioned is that whereas you can see a supply response to a higher gold price, so the gold price goes up, and then miners say, okay, look, gold miners say, look, we're going to get some more gold from this area here that we couldn't get before because it wasn't economic. You could see a pretty quick, not very quick, but you can see a somewhat kind of time-oriented supply response to an increase in the price of gold. You don't really see that for silver. So the price of silver goes up a lot. If it goes to 45, and the price of copper stays at $4.75 a pound, you don't see that supply response on a silver perspective because the copper miner is going to keep on pumping out the same amount. So that's what makes the silver dynamic a little bit more attractive, I think, even on the upside for silver. Now, that being said, yeah, in this higher copper price environment, to the degree that the copper miners are now doing the same thing that I said the gold miners would do, it is a little bit of a headwind for the silver price.
Do you think money is being diverted away from gold into Bitcoin? And do you think a lot of the investors that used to invest in gold are now investing in Bitcoin?
I don't really think so. I think that the most rational response would be, it has to be to some extent, but I just don't get that feeling. Like one example that I have to get, I really haven't told anybody this, but it's funny. My 13-year-old son has a game on his phone where he's poking at like the names of, like, instead of Mercedes-Benz, they call it Mercedes-Bands or something like that. And instead of Google, they call it Goggle. But all he does is he looks at the chart and he goes, do I think the price of this stock, quote unquote, is going up or down? And like, I go on the train back and forth to New York City and I see people doing a similar thing, like actually on their phone betting on stock prices and things like that, and these meme stocks and whatever. So I don't think it's the same buyer. I think Bitcoin also has people like, doing similar. It's driven. I do think now Bitcoin lovers are going to really get mad at me, but I do think a lot of it is driven by this, like this momentum kind of day trading on the apps and stuff. Now, could gold get that kind of bid at some point? Well, I sure hope so. And could that be manifested and maybe flows into the ETF or something like that? I hope. But I mean, do I think that it's taking away a lot of interest? I think it is on the margin, but I don't think it's taking away a lot of interest from gold. I mean, it's a different buyer. It's like central banks, like you're saying. I mean, hopefully pension funds. It's big funds. It's not really that retail buyer.
And in a holiday shortened week, Stephen McBride, the chief strategist at RiskHedge, talked about AI and the biotech world. He also touched on some of the big players in the artificial intelligence world and what AI means for some jobs.
So you are currently in Dublin, but you're actually making a move to Abu Dhabi here in the coming year. And I'm curious, why do you want to move there? Why not move to London or Paris?
Yeah, so I've been to Dubai and Abu Dhabi many times, James, and I was just incredibly impressed by the forward-looking nature of the company, or the country, sorry. They get almost all their drinking water from desalination plants, and they're just finished construction and opened their fourth nuclear power plant. You think about what that country was 30 years ago, right? Go look, it was one or two buildings beside the seaside, small little fishing villages. And now you go and you see what they've been able to do. So really, I want my kids to grow up in an environment, in a country around people that are strivers. And Abu Dhabi and Dubai have that in abundance. I think 85% of the population of the country is actually not Emirati. It's really a collection of people around the world who have moved there to build a better life for themselves. And I think I want my that mentality to rub off on my kids. And also, we're going to talk about AI. UAE is absolutely one of the leading countries outside of America on AI. They've launched AI models, so that makes me even more bullish.
And when I think about Abu Dhabi, I guess I think about billionaires, right? What's the cost of living like there, and what's the cost of real estate or to own a home?
Yeah, so look, obviously there's zero tax, and it does come across as quite luxurious, but it's actually quite affordable. When you take into consideration, I actually have a friend who just recently moved from Dubai to Toronto, and he said all in, Dubai is actually cheaper. That's despite paying, 70, 80, 90K rent for a villa. Dubai real estate is actually quite affordable. You'll get a decent, 3-bedroom villa in a nice area for $500,000. So all in, when you consider you're not paying tax, it actually works out cheaper in many ways.
So you mentioned NVIDIA, and that's like the poster child for AI. And it recently went through an all-time high of $1,000. They just announced a 10-for-1 stock split. What are your thoughts on NVIDIA? Does it keep going, or is it overdone here? And as a reminder, the market cap on NVIDIA now is $2.3 trillion.
So, I've owned NVIDIA since 2018, so I'm a little bit biased, or I'm speaking from a position of strength. We did sell half the position earlier this year, just to take profits after it ran up so much. I believe it has further to run. Look, the biggest cash-rich companies in the world, Amazon, Google, Microsoft, Facebook, they're going to spend over $170 billion building AI data centers and other infrastructure this year. It's going to be over $200 billion next year. A huge amount of that money is going on chips. Okay, so I don't think it's time to sell NVIDIA yet. I think it has further to run. I think before this bull run is over, it actually becomes the world's largest company, which would make me a little bit cautious. Maybe that is the sell signal. But you actually look at where it's trading on a forward PE basis. As much as the stock has run up, its earnings have run up even faster. So as of yesterday, pre-earnings, it was trading near its 5 range low on the forward PE basis. So I think it has further to run, James. As I said, it's actually more than justified the move it's had.
When it comes to semiconductors, Intel has been around for many decades, and yet they've kind of lost this battle, and it's really underperforming NVIDIA. Well, what's happening with Intel? Are they able to compete with NVIDIA?
Yeah, the short answer is no. They blew their lead. And when you look at the history of semiconductors, usually when a company gets a lead in a certain sector, it usually stays there for a very, very long time. It's actually rare that, within the verticals in semiconductors, you get change. So I really think Intel is not prepared for the AI age. I think it's been beaten by NVIDIA on one side and TSMC on the fabrication side. So I think there's a lot better stocks to own, not just in AI, but just in semiconductors in general. I think, people might be a little bit bullish on Intel because it's building all these fabs and it's spending all this money and it's getting all these subsidies from the government. I would say to you that a better bet is to buy the semi-cap companies, the machines, because 70% of one of these cutting-edge fabs, 70% of the money, and we're talking $30 billion for a fab, 70% of that money goes towards the machines. That's companies like ASML and Lam Research and Applied Materials and KLA-Tencor. They're the companies that are going to be earning all this money. So that's the better bet.
Let's talk about AI and jobs now. There's a lot of concern that AI will disrupt the job market. And it seems like everyone I know in North America, they're looking for work, okay, and they're looking for good paying jobs, and they can't find any. And I don't know what it's like there in Ireland, but the job situation here, it's not what you're. It's not as good as we're led to believe it is, okay, according if you look at government numbers. And I guess my question to you is AI already disrupting the job market? Is it already displacing workers?
So I think the fear about AI replacing jobs is completely overblown. I want to give a shout out to our friends over at Pessimist's Archive. They wrote this great article about how robots have been about to steal the jobs for 100 years. And it's all these examples of every decade about people saying this technology or that automation is going to take all the jobs. And of course, what ends up happening is technology you almost always creates more and better jobs. I think it's going to be the same for AI. Look, I'm not saying it's going to destroy no jobs. I think if you put a gun to my head, and I think customer service is one of those industries that will maybe have 10% of the workforce that it does today in 5 or 10 years. But what I'm really focused on, James, and what I think the world needs to embrace is that how AI is going to allow us to move up the value chain and actually help people that really need that help. For example, if you talk to teachers today, they spend less than half of their time actually teaching the kids, right? It's grading homework, it's designing lessons, it's, all these rules and regulations that they have to comply with. What about if we could just automate all that away with ChatGPT, okay? Just you can design, not only design a lesson for the class, you can design lessons for individual students based on where they are. So, you might be ahead of me in math or whatever. You can design individual lessons for us. Wouldn't that be so much better? Similarly, in healthcare, here in Ireland, you're waiting, 2-3 years. Some cases, I'm not joking, for an appointment. What about if we create AI assistants to radiologists and doctors and automate away some of those lower level functions so they can actually serve more clients, perform their jobs better? So I actually think this is going to be an amazing thing for humanity. I think a lot of the BS jobs that we have are going to go away, but this technology will create so much prosperity that we will be more than better off than we were before.
Thank you for watching this week's recap, and don't forget to head over to Wealthion.com for a free, no-obligation portfolio review with one of our registered investment advisors. You can also follow us on social media for the latest news and information to help you invest wisely. If you haven't already done so, please make sure to like and subscribe to our channel, and don't forget to turn on notifications so that you never miss a video. Until next time, stay informed, be empowered, and may your investments flourish. If you like this content and are looking for more ways to grow and keep your wealth, watch this video next.